Barry, I have to say I read that line and thought that maybe it was wrong. Why a slower recovery in the labour market off the back of a monster fiscal package?
Oh, very similar reasons to what happened in the last business cycle when, typically Congress will extend unemployment benefits from 27 weeks. Last cycle, it was to 99 weeks. They rolled that all the way until the very beginning of 2014 last cycle. And turns out the strongest year for the labor market recovery through the entire, almost 11-year expansion was 2014 when they finally ended those benefits. Jobs openings surged. Unemployment rates for less skilled workers dropped precipitously. And it was the disincentives to look for work that really did slow the labor market recovery. We saw the same thing last summer when there was the $600 expanded unemployment insurance. You had supposedly a fiscal cliff that we were going to go off in August, yet the opposite occurred. The labor market recovery didn't slow at all or stall at all. You could see it in the recent weekly jobless claims. You had a continued decline in continuing claims across all of those programs from Thanksgiving through the end of the year. Then you reinstated the programs, and we saw those claims jump right back up. So, listen, the argument that you should be doing this is certainly valid with governors locking down states. But now that the lockdowns are lifting, the vaccine pipeline is clearing. We've been delivering, almost 1.5 million per day on a 7-day average. You've got to ask yourself, how long do we want to continue to add that extended or expanded unemployment insurance? And do we continue it all the way through this summer? Yeah. In which case, the labor market recovery just stalls in the summer.
But Barry, as you point out, sir, this is the difference between calibrating the response for when the economy is shut down and when it reopens. Is that a decision to make later on in the year?
Well, I thought that the 10 Republican senator proposal to extend it to the summer and then see where we're at made the most sense. Extending it clear through the summer at the point when we're opening up seems to me to be overkill. But, listen, Thomas Sowell said this a long time ago, right? There's no solutions. There's only policy trade-offs. So the minimum wage is clearly a policy trade-off based on CBO analysis, right? So is this expanded unemployment insurance. It's a trade-off. The trade-off is a slower recovery, but just a number of people that wouldn't be able to find a job get extra unemployment insurance.
They want to run it hot, Barry. Do you think they'll be successful?
Oh, I do for sure. I think that there's just so many conditions that are different than 2009. The level of household debt to disposable income, level of financial sector debt, the size of the liquidity injections. Larry Summers articulated this pretty well. It's just so much greater with a much lower debt burden. They're pumping a lot of money into the system. And I think that people forget about the 3 disinflationary shocks we had in the last half of the last decade. We had a 75% decline in the price of oil because of shale-related supply. Then we had the Tax Cuts and Jobs Act, which shifted the supply curve out and caused disinflation in a range of prices. We had service sector disinflation because of productivity enhancements, technology innovation adoption. And then we had the trade war, right? And that caused oil prices to fall again, commodity prices. So these were a series of shocks, none of which exist today. I look at the go forward, and to me, this looks like the beginning of the 1960s. We have a change in emphasis at the Fed. We have the beginnings of a reflationary cycle. At the beginning of the reflationary cycle, it's actually a net positive, particularly for markets like the equity market. Nominal GDP will go up, revenue growth will go up, earnings growth will be faster. But eventually, it'll start to degrade margins and impact valuations later on. So, the reflation is different than inflation. And the Fed reaction function to this is critical, as you mentioned in your last interview. But I think we have a ways to go before we worry about this.
You can see why people are uncomfortable, though, Barry. You've got an equity market just off an all-time high. You've got borrowing costs for junk credits at record lows and credit spreads at pre-pandemic tights now, just going into the pandemic back in January, February time of 2020. I just wonder from your standpoint, Barry, what's your message for the people to bring that up continuously? Is it normal to have that dash to trash at the start of the recovery? Is it normal to see valuations this extended before we even get going?
Oh, for sure. And if you're watching the earnings estimates just continue to go higher, my whole perspective on the GameStop saga was this is the same thing that happened in 2003 with internet stocks that had fallen from 100 down to 3. AMD went from 40 down to 5. They rebounded sharply early in the cycle. The same thing happened with challenged financial companies in 2009. So there's nothing unusual about this for the stage in the cycle, but there will be a point 3 months from now or so when inflation break-evens have gotten to levels that make the Rob Kaplans of the world uncomfortable, right? The Rob, not of the world, but of the FOMC specifically, and they will start to balk. And so the sequencing of events for me is critical. Inflation break-evens push above 5-year forward, pushes well above 2.5%.
Yeah.
The inflation aggregates continue to be firm by mid-year or so. And then you'll have some of the regional presidents start talking about, well, maybe we ought to pull back on the asset purchase program. Real rates will move sharply at that point, like they did in January 18 or September 18, and you'll have a risk-off event, 10% equity market correction.
And Barry Knapp will be on this program with me talking about it